China's economy has long been a subject of global fascination and scrutiny. But what happens when the world's second-largest economy starts withholding the very data that offers insight into its health? New reporting by the Wall Street Journal indicates exactly this, from missing GDP figures to the suspension of key financial indicators. China is making it harder for outsiders to see what is going on under the hood of the world's second-largest economy. According to this new report, starting earlier this decade, China has withheld the further publishing of fundamental economic data, including land sales and youth unemployment. Furthermore, more subtle economic indicators such as new stock market investors, toll roads debt, cremations, and even soy sauce production. These, while not traditional economic figures, can help paint a more complete, nuanced image of what is going on deep inside the Chinese economy. And here too, the data has been redacted. As outside observers, we can only assume this is an attempt by Beijing to control the narrative. Official figures from Beijing paint a picture of a strong and steady recovery from the pandemic, with impressive future growth prospects. However, in reality, this is almost certainly not the case. Let's start with manufacturing. China's Purchasing Managers' Index, PMI, a key measure of factory activity, recently slipped to 49.0, indicating contraction. This isn't just a blip. It reflects real pressures from weakening demand and ongoing global trade tensions. Exports are down, new orders are falling, and companies are starting to feel the squeeze. The real estate sector, long a pillar of China's growth, remains deeply troubled. Major developers like Evergrande and Country Garden have defaulted or are teetering on the edge. Home prices have dropped in many cities, and new construction has slowed dramatically. Consumer confidence in property, once a go-to investment, has collapsed. Then there's youth unemployment. While China stopped publishing this data in 2023, independent estimates suggest it may be as high as 45%. That's nearly half of young urban workers struggling to find jobs, a serious drag on both growth and social stability. At the same time, consumer spending remains stubbornly weak, despite government efforts to boost domestic demand. Households are saving more and spending less, often interpreted as an expression of deeper concerns about the future. So, while China claims robust GDP growth of over 5%, many analysts believe the real growth rate could be closer to 3 to 4%, and possibly even lower once distortions are accounted for. In short, China's economy, while not in danger of immediate collapse, is not as robust as Beijing would want the outside world to believe. Then, we have this report from CNBC warning of a new emerging threat for China. Deflation, characterized by a general decline in prices, might seem beneficial to consumers. However, it can signal deeper economic issues. In China's case, several factors contribute to this risk. 1. Excess production capacity. With reduced export demand, manufacturers are redirecting goods to the domestic market. This oversupply can drive prices down as companies compete for limited consumer spending. 2. Weak domestic consumption. Despite government efforts to boost spending through subsidies and discounts, consumer confidence remains low. High savings rates and concerns about the economy lead many to hold back, exacerbating the deflationary trend. And 3. Challenges for exporters. Many exporters find the domestic market less profitable due to intense competition and lower margins. This reluctance to shift focus inward limits the effectiveness of policies aimed at stimulating domestic demand. The combination of these factors creates a scenario where prices continue to fall, potentially leading to reduced business revenues, job cuts, and further economic slowdown. At the heart of China's current economic fragility is one key factor: weak consumer spending. Despite being the world's second-largest economy, China's growth has long been fueled by investment and exports, not household consumption. Contrast that with the United States, where nearly 70% of GDP comes from consumer spending. Even in the face of rising interest rates, inflation, and geopolitical tensions, the American consumer has proven remarkably resilient. Spending has remained strong across sectors, from travel to tech, helping the U.S. economy defy expectations and continue growing. So, while China's economy faces mounting uncertainty, the months ahead will reveal whether Beijing can restore confidence or if the cracks in its economic model will continue to deepen.